And back to our top line conversation, the TSX is trading in record territory as it sees a jump in Valiant Pharmaceuticals. Joining us now for a closer look is Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management. Diana, good to be with you. Thanks for coming in.
Thank you.
We continue to see these markets, grind higher, march higher. Not major moves on a day-to-day basis, but the upward trend is definitely continuing.
Actually, there's all these indicators that we watch, and we have some short-term and long-term indicators that we follow on a disciplined basis. And the short-term indicators have actually come in to a level where nothing seems to be overbought, and this is happening at a time when the indices are trading at highs, which may point to some rotation, but definitely does point to the fact that we are not as yet overbought. I know we keep trying to anticipate when the top will be, given how well investors may have done over the course of the year. And now, thankfully, Canada is also participating and has caught up in the last month or two.
Which was your call?
Which we thought might happen, yes.
You thought that the TSX might play a bit of catch-up, and it has over the past number of months. But the question right now is there are a number of uncertainties, of course, NAFTA being one of them. A lot of people saying there's too much complacency in the market, not pricing NAFTA risks into the market. Are you concerned? Are you putting on hedging positions or trimming? What are you doing?
No, we're not.
No.
And this is the conflict that an investor, of course, would have, and an asset manager sometimes as well. Markets keep going higher. They tend to move higher on fundamentals such as earnings, economics, data. NAFTA certainly is a risk, and you and I discussed this, I think, a month or two ago. In this forum, we said NAFTA certainly is a risk to Canada. This is before we thought maybe Canada will catch up into year-end. And NAFTA still is a risk, and it'll grind out longer than anybody's expecting, in my opinion. This will be. It's just like the tax reform in the U.S. It'll take longer, with more negotiation than anybody thinks. I think the market's coming around to that.
Well, that might be a positive versus the alternative, it being a binary event in the short term.
Yes, and plus,
NAFTA,
NAFTA too. That's right. And, if something should affect certain industries or companies negatively, perhaps there's more time for them to prepare. And as you know, turning a ship around doesn't take overnight, so maybe there is something there. That being said, when we're talking about risk in the markets, and we're still fully invested, and no, we're not hedged, and we've increased our energy exposure as it started going higher because we liked the relative strength. But there's a lot of areas in the market that are working, so no need to fully overweight. But policy mistake globally is probably the single biggest risk outside of things we can't control, such as war.
What do you mean by that, policy risk? Are you concerned that the central bankers around the world are
central bankers, NAFTA, trade negotiations, doing the wrong thing, wrong policy on artificial intelligence?
That's years out.
Exactly.
What's a more near-term risk? From a policy perspective.
So from a policy perspective, near term, there isn't a high amount of risk, which is why we're still fully invested. So we know that there will be a rate increase in the U.S. next month. And a lot of people have priced in that Canada might have a rate increase also come early first quarter. Some are calling it in January, coming out of Canada. We have a new Fed chair, which outside of the fact that he's a Republican, nothing is differing in his views relative to Fed Chair Yellen. So that wasn't a big deal. And the tax report that was put out last week, 429 pages of recommendations, nothing there was surprising, plus nobody believes that everything is going to go through. So what is a policy mistake would be really over time going too fast, say in rate increases. Say, for example, we get next month some narrative from the Fed that they are going to taper a little too fast, but we have a yield curve that's flattening, and the Fed is still buying the long end, and that's probably part of the reason why. So we'll see what they do with their balance sheet conversation.
Buying the long end?
Yeah. the QE buys tends to buy the 10-year, which suppresses the yield, and the 2-year
and raising
is pricing in the rate increases. So we have that going.
So Diana, I just had Tom Ditsuras on from Strategas. I don't know if you follow his work.
I didn't. I heard some of the stuff from before, but I saw him, but I didn't hear him.
Because I think that you seem to have similar views in terms of, yes, there's a flattening yield curve, but it is for those reasons, and that even though a lot of investors are talking about whether or not a flattening yield curve turns into an inverted yield curve and signals a recession, they don't believe that is the case, and you don't either. And I guess I'm just wondering, I just need more confirmation as to why.
I guess I'm saying that we don't know whether a flattening yield curve will turn into an inverted yield curve. We've been at this level of flat curve 2 years ago and several times before. Strategas has actually put out a little note a little while ago just highlighting how long it takes from a flattening yield curve to an inverted yield curve. And some of them it took a year, and market over that time worked really, really well. So markets don't need to start selling off according to them, when the yield curve flattens.
That's this report.
Oh, I have some other chart here, but
I've got it right here too.
Okay.
Yes. Exactly it.
Yeah. So anyway,
for our viewers to see, but I'm going to somehow tweet this out because it is really important. If when you see the yield curve become a little bit flat, I mean, you can see 12 months, 7 months, 34 months, 10 months where the market still moves higher.
That's right. But before we get into so they're saying inversion likely, but before we even get to an inversion, it's happened before that actually it flattens and then it steepens again, or moves up, or it doesn't have to invert just because it has flattened. So I'm not making a call what will happen to the economy going forward. We have an inflation issue. We're trying to raise rates, normalizing, coming off some low level, because we've realized that the marginal utility of lowering more rates doesn't help the economy. So now we're going to normalize. Whether that's going to increase inflation expectations, which is a must in order to create some inflation, will take time. So we'll have to see.
And Dana, we're going to take a short break, and then we're going to come back and get more of your investment ideas. But I just want to be really clear with our viewers as well. I don't mean to get too in the weeds with the yield curve and the inversion, but you have the chart right there with you. I mean, this is what, and I didn't know that. I mean, this is what this is what people are focused in on.
Yeah,
so
absolutely.
we have to address it. It can lead to what will come in the markets. But we'll take a short break. When we come back, more ideas from Dana Avigdor, portfolio manager and head of Barometer Trading at Barometer Capital Management. We'll be right back.